to the latest episode of the Financial Frontier. I'm your host, Patrick Camuso. I'm joined by a returning guest, Tyler Menzer, the assistant professor of accounting at TCU and the co-author of a recent research paper that uses IRS administrative data to examine who actually reports cryptocurrency to the IRS. And that's going to be the center of our discussion here today. Tyler, welcome back on to the Financial Frontier.
Yeah, thanks for having me.
Absolutely. So before we get into the specific findings and more of the details around this study, can you give listeners a high-level overview of the paper and the work you did that went into this, and what questions were you and your co-authors trying to answer? What data did you utilize to do this analysis, and what were the overall results?
Yeah, so this is a paper, just to give listeners a little bit of an insight, how the academic process works, that I started in my PhD program back in probably 2019 maybe. So I was still in the PhD program. And myself and my two amazing co-authors, Aaron Wild at the University of Iowa and Jeff Hoops at UNC, who I do have to plug and say for your listeners, if you want some more tax podcasts, him and another professor at Duke, Scott Dyring, have the Tax Chats podcast. So, I feel like we can never have enough tax podcasts.
I agree with you there.
If you're looking for some more even after this, go and check that out. But the three of us, I had worked in public accounting previously and worked on crypto in my office. And so I had an interest there. It was around the time when crypto was just, really coming a little bit more mainstream. And I think Sharon, my co-author, had sent me an article once about, is crypto becoming the tax haven, the new tax haven, right? Because there's a lot of talk about people moving to the Bahamas and places with no taxes, and somewhat nice weather to get out of reporting their gains. And it was like, is this the new tax haven, right? And so we kind of just started talking about it, looking at the reporting, got in contact with the IRS, who has a research division. So for those who don't know, actually in federal law, in the Internal Revenue Code, there is a couple of provisions that say, hey, the IRS will actually do research to help taxpayer enforcement, taxpayer compliance, that sort of stuff, the IRS's mandate, and that allows them to share data with external researchers. And so we can come in, bring in kind of the outside skills and resources, work with IRS data, and then hopefully, our findings both, one, help us from a academic side, we're getting information out there, but also help the IRS on the internal side and help them understand what taxpayers are doing, what's going on kind of under the hood there. So we got in with the IRS. They were obviously interested in crypto, as I think every single taxing authority was and really still is. And our question was really simple. It was like the title of the paper, who is reporting these to the IRS? Myself, I knew that I was reporting my crypto sales. So I knew there'd be at least one, but we really didn't know how many, what the extent was, really what these taxpayers look like. I think our study to a non-academic audience is actually pretty approachable. Hopefully you found it pretty easy to read. It's very descriptive, right? We really don't have, when you think of a normal kind of test or a hypothesis, we just say, if we have this data, let's take a look at it and figure out what's going on. Figure out what cryptocurrency reporters look like, who they are, how many are there, and just kind of dig in from there. I think at one point we had really kind of started the project being interested in the cryptocurrency checkbox that went into effect in 2019, 2020. I remember that offhand. But we started just like looking at who these were and looking at what we call the descriptive statistics. And it was like, this is a lot of interesting stuff. Let's try to just write a paper on this. And so that's ultimately what we did. And so we, ultimately look at over 1 billion tax returns. Basically, if you filed a tax return, you are in the data. Now, I can't tell who you are. It's completely anonymized. I have no idea who any of these individuals are, but we look at the whole universe. Every tax return basically filed between 2013 and 2021. We use some kind of textual analysis, machine learning a little bit to look and identify, who we think is reporting cryptocurrency. based on, the actual tax return data, and then ask, what do these individuals look like? What are we seeing?
Yeah, so the study is extremely interesting, and I encourage everyone to check it out. I'll definitely link to it in the show notes here. Um, and you went right to the source data, and it is a very large data set, like you said as well. It really is pulling from the best data possible. Now, you are a returning guest, and last time we spoke, it was around some previous research that you did regarding software accuracy for cryptocurrency softwares, and we were heading into the first 1099 DA filing season, and that was basically the framing of our conversation then. So we're getting through that first season now, and now you have published this new research on looking at who's being compliant with digital assets. So do you see that these two research projects connected in any way, conceptually, or do you see any sort of unique insights or overlaps between the two?
No, I mean, this is obviously, again, the publishing process takes quite a while. So this was started well before my other paper that we talked about last time. But they definitely both fit into this. How is the IRS dealing, right? And in this paper, we're really looking at the actual reporting, right? Who actually reports? And we don't get into a lot of, how much are you reporting or how many transactions, because tax return data just isn't very good for that. As I'm sure you know, Patrick, a lot of times accountants, we just summarize transactions on the 8949, or we don't, we just attach stuff rather than listing out every single sale. And so I see them as very complementary, right? My prior paper looking at the reporting software is, okay, how are people actually preparing their returns, right? This is of all tax filers, how many are even getting to the step where they are filing? One thing we can't see, and I, kind of always have to put these caveats out there, right? We don't see who doesn't, right? Who owns cryptocurrency, who had sales, and who doesn't file. So this is really looking at that set of taxpayers who both have cryptocurrency and decided to actually kind of put it on their tax return and file.
Yeah, and I think it's interesting because you're starting to see in this study who's filing, and you get into the level of sophistication of some of the filers, which we'll get into. And then if you relate that back to this software study, it's a question of then who's accurately filing, right? Because it's probably even a smaller subset of that first study. So I think it's interesting from that perspective. And as you alluded to, correct me if I'm wrong, I believe the time frame for the study for this most recent one with the compliance is 2013 to 2021.
Yes.
So, this time frame obviously predates Form 1099 DA. And I know there was some interesting data in there around the digital asset checkbox question. So do you have any plans in the future to start looking at, future data and adding to this study, possibly like post 1099 DA, to see what kind of effect that has? Obviously, that's probably a bit of time out, but is that on your radar as well?
No, that's certainly something I would love to do. The way the process works is we'll have to kind of apply to the IRS again and go through the whole process, get them to approve it. So whether that happens or not is not entirely on, I would say, our shoulders, but we definitely would like to do it. And I think it will be very interesting, especially in next year as we get the 1099 Ds or 1099 DAs that are reporting basis, right? Because that's really where I think the rubber hits the road. With just in this past year, right, this tax season, just had the proceeds on there, and you can make up the basis, right, to get to the number that you want. But once the exchanges start reporting basis, I think that really narrows in, and is going to kind of change how people kind of have to respond and report on their taxes. And just one thing to add, because I know, it kind of comes up, and it'll be like, oh, there's a study published in 2026, I think is the technical date on it. Right? Why are we only using 2021 data, right? Why don't we have data from more years? I don't know if you thought that when you were reading through it, but just to kind of give people a little bit of insight into how the sausage is made. So you think about, okay, well, we have 2021. Well, that data, right? Those returns aren't filed until 2022. We wanted the full year of return so we know people can extend. Patrick, I'm sure you filed your return right on, February 1st after you got the W-2 done. Myself, I still have not filed my 2025 return. It's on extension. And so then we're out and we're saying, well, we think returns will basically be filed, October 2022. Well, then, right, we don't actually have access to the databases where those returns are filed, because obviously that's got all of your information, your actual social security number, all that is in your return when you file it. So we then have to wait for the IRS to take that data. Now at the end of 2022, they have to clean it, they have to anonymize it, get it all into kind of a usable format, and upload it into the system where we can access it, right, on that anonymized basis. So that gets us onto 2023, kind of the middle of the year. And then we have to analyze the data, write the paper. And so it actually does, kind of create this lag where we don't get the data immediately. And then once we're in kind of the publication process and the review process, it's kind of can be hard to kind of add, hey, we're going to add a few more years and completely change the paper 3 rounds into the review process when it's almost being published. So
yeah, it takes some time. There's a lag just on filing the taxes themselves. And then there's obviously a rigorous process that you guys went through in analyzing this data. So it's no small undertaking. And I agree with you. We probably need to see a few years of this 1099 DA filing process to mature, and we start to see cost basis data get phased in. But it would be very interesting to see what that does to some of these compliance numbers that we're going to discuss here when it does get phased in, which is kind of what I want to get into a bit, into really what your findings were for this tax period. And this was kind of a hot topic in the headlines when this study came out a month or 2 ago. So correct me if I'm wrong on the numbers, because I want to make sure we get them right. You estimated in the paper, based off of the findings with you and your co-authors, that 32 to 56% of US crypto owners are reporting sales to the IRS. And what we did see in some headlines was the number 6.5% that was getting thrown around. And that is also referenced in your paper, but just based off of all American adults. And again, you can correct me if I'm wrong on this. So first, I'd like to give you the floor to validate those numbers, and then also just comment on that a bit. Anything, any perspective you want to give just around sort of those high level results.
yeah, I think we can start at the 6.5% because that did get, I think, a little bit misreported, or the game of telephone tag that is some of the news reporting. So what we do, right, because we look at tax returns. So we first say, okay, well, we have a number of tax returns, over, I think, 1.2 billion tax returns that we analyze. Obviously, tax returns can be multiple people, right? We kind of do it simply. We ignore children, for lack of a better word, unless they're filing their own tax return. And we say, look, if you are filing, right, single or head of household, we're going to count you as one taxpayer, one adult. If you file married filing joint, we're going to count you as 2 taxpayers. And so in our whole sample, we get, again, I have to look back at the numbers, about 220 million taxpayer individuals. Now, it's not tax returns, it's individuals that we find. We say about 6.5% of those reported cryptocurrency, right? So that's giving we know about tax reporting, right? Not everybody has to file a return. We obviously know there are more than 200 million people living in the US. We're not capturing kids. So, if you've got a high schooler trading crypto, we probably are not capturing them. So that 6.5 number is really among everybody that's filing tax returns. We see about 6.5% of them are reporting some form of cryptocurrency that we identify. From the 32 to 56, right there, we said, look, we don't know how many people have cryptocurrency, right? They own it, they're trading it, but they're not reporting it, right? We don't get that information. Obviously, they're not telling the IRS, hey, come audit me, I have cryptocurrency, I'm not telling you about it. Right. And so we're trying to think and say, okay, well, how can we estimate this? Right. We know this is a limitation of our data. We know this is part of, why we want to look at this. And so he said, look, let's just, let's find a bunch of stuff. And so we kind of look at 3 different data sources. First, we say, let's look at some surveys. Now, I have been a pretty vocal, I don't want to say opponent, but a lot of the surveys of cryptocurrency owners or cryptocurrency users that are done by crypto exchanges are not particularly well suited to actually tell us how many people own cryptocurrency. They will get numbers of 20 or 30%. because it's like, yes, if you ask somebody on your crypto exchange if they own cryptocurrency, the number of people who own cryptocurrency is going to be really high. And so we use, I think, 3 different surveys from Pew, the Federal Reserve, and I'm just going to look up. I'm going to have one other one, and YouGov, because we said these are good quality surveys, good reputational pollsters, and they had samples that were large and representative of the U.S. population. Right. So we think we're getting a pretty good sample of US individuals in those surveys. And we want to say, okay, just in the general survey, how many people are saying they own cryptocurrency? Compare that to how many people we see reporting in the same year for our IRS data. Right. So that's one source we use. There's then another academic paper by Aiello et al. Hopefully I'm saying his name correctly, but they had some really interesting credit card data. So they actually got data on individual credit card transactions and were able to look and say, okay, we can see when you're sending money to Coinbase or Kraken or Binance. And we're going to assume that if you're sending money there, you're buying cryptocurrency, right? Pretty, I would say, safe assumption. People are probably not sending it there and just keeping it at USD. And so we look and say, okay, well, we know the percentage of their survey or data of credit card users, which I think is most people. They have a really big sample. What percentage do they see sending money to exchanges versus that we see reporting? Right. And then finally, this is probably where I'd say have the biggest kind of caveats around or asterisks. And well, we have one public cryptocurrency exchange, Coinbase. They report on the number of users, and we go through it in the paper, but we kind of say, okay, well, what's Coinbase's market share? We kind of adjust for that. We adjust for their level of foreign sales versus US to kind of say, okay, how many users do we think Coinbase has in the US? We kind of probably estimate a little bit high using their own reporting. And that's our kind of third methodology. All 3 of those actually come in, I would say, quite like super close because it's about, 10, 20 million differences, but, between 31 and 54 million individuals, if we kind of put that out to the full population. And so that's what we're comparing to. And we're saying that 32 to 56% compared to these other estimates that we think are just like, hey, here's everybody who actually just owns cryptocurrency, or in some cases who has owned cryptocurrency in the past.
Interesting. Yeah. So this 6% number ultimately is lower because you're looking at the entire population, many of which don't necessarily own crypto. So it is useful and it's an interesting number. But if you're trying to frame the overall compliance of crypto industry, it's more realistic to use that 32 to 56% that's based off of these various data sources that you've accumulated that give us probably the most accurate proxy possible on who's actually holding and transacting in crypto. Were you able to supplement any of those data sources in factor in any blockchain data like from the Bitcoin network regarding the transaction volume on there compared to how anything's reported?
Yes. So we do look at transaction volume. We just kind of pick Bitcoin because I think it's largely representative of the amount of volume that you're getting and interest in cryptocurrency generally. And so we kind of look and say, okay, we do have estimates on an aggregate level of how much sales proceeds are being reported on the tax returns. We have the blockchain data as far as how much volume is being reported on a daily basis. I like to think of this as probably having a little bit higher error bars, but it allows us to kind of assess, right, what's the magnitude, right? Because you can imagine, well, right, if everybody who's, got $1 of Bitcoin is reporting, then we might not be capturing a whole lot of it, even if we're getting a lot of taxpayers. If you got one person that reports $1 million gain or a $10 million gain, right, that person does a huge amount of tax, but only counts as one person, right? It's still one taxpayer. The limitation here, there are again, big caveats, right? We can't separate out blockchain data by country, right? We don't know who's transacting, whether they're in the US, subject to US rules, whether they're anywhere else in the world. We don't know if it's individuals versus businesses. We don't see any exchange data if we're looking at the blockchain. So with all of that, right, what we're really trying to do is just say, okay, when Bitcoin volume goes up, we should expect more people to be trading. right? Simple assumption that I think we can all agree on. If more people are trading, we should expect that the reported volume to the IRS goes up around those same times. Right? And we generally see it does. Again, the magnitudes are very different. I don't want to read into that too much because I don't think we can say much about that given the limitations on the data. But I think it says, hey, when cryptocurrency is being traded more, we do see more sales. That is exactly what we would expect if people are reporting.
Yeah, and I would say anecdotally, that's what I see in my practice, right? When trading volume goes up, there's more transactions. Most transactions are taxable events. Therefore, more people are reporting. So I agree. You got to take with a grain of salt because of the anonymity and of, it could be across many tax jurisdictions, but it is another interesting data source to take into account. What were the findings on that compared to some of the other percentages when you were looking at more of the standard data sources?
So I don't recall the percentages offhand. Don't think the percentages there are very informative. They were relatively small just because, again, we're only getting a subset who are reporting, right? And we're not getting exchange volume. And so I think there is Coinbase's even in, 2017, 2018 timeframe, right? You had big exchanges, they're centralized. The blockchain volume is also going to capture when Coinbase is moving stuff around.
Yeah.
And so, as far as a percentage term, I don't really like comparing that because I don't think it's very informative. I think directionally is what I kind of try to use and say, is it going up when we think it's going up? Is it going down when we think it's going down? If I do recall correctly, I think one of the interesting things is like back in 2014 or 15, I think, right? There was a big spike in volume for a year or so. And we didn't see any spike in reporting in that, right? In that early part of the sample period, which I think is kind of what we would expect, right? Nobody was, especially pre-2014, right? The initial notices that the IRS put out, people were just not reporting cryptocurrency. And so, if you go back further, we don't see as much kind of co-movement between IRS volume and the blockchain. In the more recent periods, we see a lot more there.
Yeah. So that's very interesting, and I agree with you. It's a good proxy directionally, but you can see it's not good to compare it to the percentages where you're using more reliable data that probably captures a more representative subset of what's going on. So what's interesting is you're analyzing this tax data. We're not able to just see how many people are reporting, but who's reporting. What types of people are reporting because we have all of this tax return data. And part of your analysis is on breaking it down by income levels and analyzing the level of sophistication of who's actually reporting their crypto. And again, correct me if I'm wrong, what's interesting is the reporting follows an inverted U where lower income and higher income have a lower compliance rate versus people that are more towards the middle income. So do you agree with that characterization? And what's your opinion on what's driving that?
Yeah, no, I think that is what we find. So for listeners, right, we use kind of the Federal Reserve survey allows us to kind of break it down in income bands. I think on the low end, it's a much simpler story, right? If you have low income, you just don't have a tax filing requirement. Doesn't matter if you have gains, you just don't have enough income to be required to file a tax. Particularly after 2017 and the TCJA when the standard deduction increased. And so I think the compliance end on the low end is there's a lot of people who don't need to. I think that's the bulk there. On the high end, I'm not really sure if we have a really good explanation. Our data net doesn't necessarily, again, we don't get to see the people who didn't report or identify them. And so, I think some of it might be differences in how people are trading cryptocurrency, right? If you think, hey, if I'm actively trading, right, I'm trying to make my bag, to really get up there, right, that's going to create a lot of taxable transactions. If you are just like, hey, I want exposure to this new asset class, I'm going to drop $100,000 and buy Bitcoin and just hold it. Right? That doesn't create taxable transaction. You might be invested in a fund that does cryptocurrency trading. And then we wouldn't see that because it's not going to be reported individually on your tax return. So I think there's different investment methods, different investment strategies that they might be using, makes it less likely they report. Obviously, if you talk about higher income individuals? We get much more into that tax planning discussion. Are they maybe using both legal or illegal methods of, not reporting or not having to report their cryptocurrency transaction, right? I think there's another paper suggesting that DeFi, right, is used as a way to kind of avoid creating taxable gains. And so, if you're doing that, that might be higher income individuals, more likely to do that, less likely to report, even though they are going to answering in the surveys, yeah, I own some of it.
Yeah, I think it's very interesting. I agree with you to, the point where we definitely have clients at my firm that accumulated Bitcoin or Ethereum in the earlier days. And maybe they did report back then, but years and years can go by where there's not going to be major taxable events if they're just really holding those positions. Maybe that's part of it, but yeah, I'm sure there's many contributing factors. It would be interesting to see some data that could unpack that, but I don't really know if it exists because, like you said, you can't go and ask the non-reporters why they're not reporting. So that's the conundrum there, I guess. But this shows even more data. The study that you did on some of the behaviors of the people that are reporting, where you looked at people that did sell crypto on their returns, but also were selling traditional stocks or securities, and their behavior differed, where they were kind of following more traditional behavior of waiting till they reach that long-term threshold and then selling some of their traditional stocks, where in crypto you didn't really see that behavior. It was more erratic, more or less. Would you agree with that, and what's your perspective on that?
Yeah, no, I think I would agree with that. We find, again, we kind of compare investors who don't own cryptocurrency. We compare the two things. First, like they have traditional stocks because they don't own cryptocurrency. We compare it to cryptocurrency owners' stock trades, and then we compare it to cryptocurrency owners' cryptocurrency trades. And here we're using 1099 data to say, when are you selling it? What is your kind of exact holding period, right? Because the 1099 is going to report the date purchased and the date sold. So we can get that down to the day. And we're really using, the quirk of the US tax system that says, hey, if you hold it for 365 plus one, that you get long-term capital gain, hold it for just that 365, you're going to get short-term capital gain. And so, in the kind of most extreme situation, say, hey, I'm going to hold one more day, and that is going to give me, 40% of the tax rate, right? You might go from 37 to 20. And so pretty big incentives. So we expect people, and prior research has shown this in traditional stocks for years, right? When you get right around that kind of kink point or bunch point, we call it, right? You see people sell less right before, they sell more right after, right? Because they're getting all those sales. Say, hey, if I have to hold it for another week, tax savings is going to outweigh any volatility. Right? The stock might go down 1%, but I'm going to save 5% on taxes. So we see that. Obviously, we kind of replicate the prior literature's finding and say we see that in traditional stocks, big bunch point at exactly that kind of 52-week holding period. We then look at, I think when we were writing the paper, we just looked at the crypto sales and said, hey, this is a lot weaker. There's still a little bit of a bump there. There's still some tax sensitivity, but it's much, much smaller. And then at one point, we were like, well, what does the cryptocurrency holders' regular stock sales look like? Right? Because you might expect them to be the same, right? They're trading both of these, but we actually find they do react to taxes quite a bit in traditional stocks. I think part of this, at least, is likely due to if you have a broker or you have an advisor, right? You might just be letting them trade. They know exactly about the 52-week holding period. They're going to kind of tax minimize within your constraints for you. And so it might be something there. It might just be, hey, I have a different mindset when I'm trading crypto. And I'm sure that you've seen this. I've seen it, right? You trade stocks, you just buy the S&P, you let it go. It's different than, oh, I'm going to find the meme coin. I'm going to do, something active. And so you might have these different kind of trading strategies that say, hey, taxes are just matter a little bit less. We do find it in another part of the paper. Cryptocurrency trade and volume is much more responsive. I shouldn't say much. It's more responsive to cryptocurrency price and volatility than traditional stocks. So you're saying crypto might go down 50% in the next week, right? I'm just going to sell when it's up, right? When I'm making money because the taxes don't matter. I just need to lock in those gains. And so I think that might be a part of it too, where there's a lot of volatility. I don't want to risk waiting for a week or a month before I sell because I just might be losing out.
Yeah, I agree with you. When I saw this, my mind definitely went to, some people are with brokers, and crypto is volatile in nature, and many people do have shorter term trading strategies, so that's probably contributing it to it. Another factor could also be that, if because crypto is non custodial and the lack of proper accounting and cost basis tracking, even if investors are aware of this and maybe do want to time this more, they might not have that data being tracked continuously like if it was with a broker, and that can be contributing to it as well. But I thought it was interesting overall. One step further, then you also looked at higher net worth taxpayers that are reporting a million or crypto in more in a year, and then you looked at what they reported after that. And what you saw in the study, and then again, correct me if I'm wrong, is that they had more gains the years following than if you compared them to someone that's like a traditional stock investor that had a comparable exit, in that they diversified into more of a unique investment set. Do you agree with that? And then how does that factor into everything from your perspective? Is it just that we have this stratified market structure in terms of participants, where at the high end there's a very high degree of sophistication, and the converse at the low end? I kind of see that anecdotally in my firm. Or is there something more to that? What's your perspective on that?
Yeah, I think, I'm going to say anything about academic research. It's that, we probably in the news and stuff don't get enough nuance, because I think there is a lot of nuance here, right? We have some stuff that says, hey, they're maybe not as sophisticated, right? They're younger, they trade meme stocks. And then we have this finding where we look and we say, yeah, right, we look at people who have over $1 million of gain the first time that they have that during our sample period. And we got to look at what happens afterwards, right? What happens to their investment portfolio afterwards? And now portfolio, I'm using loosely here, right? We only see when they sell. So if they just buy and hold, we can't see that. But we find, regular stock millionaires, right? They get it. They get that big boost in income. It stays up like you might expect. So if you have a really big gain, you still have a lot of income in future years. Cryptocurrency, we also find, you have a big gain, you have more income in future years. And we look at gambling, because really it's like, right, we have cryptocurrency. What are the two closest things? There's traditional investments and there's gambling, as we have maybe been more aware of than ever with Polymarket and Kalshi and stuff, right? These are very similar bases. And then at the time, there were all these articles about like, who are these crypto millionaires, right? I remember you remember seeing these articles about like the kids who, mined or whatever are now, multi-millionaires for their families and all these things. It's like, is this actually helping, right? Because we know, right, if you look into like lottery winners, right, a lot of lottery winners end up going bankrupt again, right? They lose the money. And so we wanted to see, like, what does this do? At least on a short time frame, right? We look 2 years before, 2 years after. We're not looking 20 years out. We don't even have 20 years of data for cryptocurrency owners in general. And exactly what you said, right? We do find that cryptocurrency owners, they actually do seem to diversify a little bit more than traditional stock owners. I think part of that may just be, if you made $1 million in gains in stocks, it was the first time you did it, but you might have already been pretty diversified, right? So we're kind of looking at that change in the number of reports. And so, if you had stocks, you might have already been kind of diversified. And now, right, you just invested more into those same stocks you had, rather than, hey, I went out and expanded into small caps or penny stocks or something, right? And so I think there's just more room for a cryptocurrency investor to expand to. And so we see them expand a little bit more. On the gambling side, right, we don't really see them expand, right? Which again, kind of makes sense. If you're just one pig at the casino, your first thought is probably not, I've got to go buy some VOO, right? And so I thought it was, it's kind of an interesting just comparison between those two groups.
Yeah, I thought it was an interesting finding, and I can say anecdotally, at my firm, I've seen many investors come and they generate really their first material wealth from some of these early investments in digital assets. And it makes sense to your point that they, part of what the data is showing could just be showing their initial investment just from this one concentrated position into a normal diversified portfolio, like you may see some of the other people that are just in the traditional markets having. So I think that's an interesting point, and yeah, it's an interesting data set, and it shows that there are, there's different types of people that are operating in this market, just like any other market, of course. Another interesting point is that in this data set, you were able to look at the introduction of the checkbox that's on the tax returns to this day that makes people answer yes or no to whether or not they transacted in digital assets. And, that's a simplified explanation of it, but that's the high level. And correct me if I'm wrong again, but what you saw there was an uptick in compliance as a result of that. And I believe particularly at the lower income reporting levels. And, I thought that was expected, but still a very interesting data point in the context of now, we're seeing the rollout of Form 1099-DA, ARF internationally, and, still have some gaps as well on the non-custodial side with DeFi reporting that was repealed. What's your perspective on that overall? And what does this suggest about some of these, some of the latest compliance design implementations? And do you think that there's more room for these in the future that can actually have a material impact on the compliance rate? Or do you think it's going to have to be increased through other measures like enforcement going?
Yeah, I think, we find so how we kind of design the test is we say, okay, well, right, one of the challenges here is that the number of cryptocurrency reporters is like good, just a straight line up, right? From 2017 up to 2021, like it was jumping every year. I think, somewhere over like half our sample is just 2021 because there's so many more every year report. And so it's kind of like hard to like say, okay, well, we know reporting is going to jump a bunch. How much of that can we attribute to kind of the checkbox?
Yeah.
Right? You're trying to disentangle this just like, hey, everybody's being reporting more anyway, right? The checkbox, what we call is kind of, some economists coined the term, right? A smart return feature. You're asking the taxpayer to like, all right, you need to check this box and tell me affirmatively you have or don't have cryptocurrency, right? You can't just leave it off, right? You can't lie by omission with the checkbox. And so he said, well, that would be interesting, right? It's interesting to see if this works. It's kind of, I don't want to say the first time because that's some of the FBAR stuff on the Schedule B and stuff. It has some of these similar features, but this, I think, to me was interesting because like it started on Schedule 1, but then it is the first question on the tax return. Before you put in your salary, you have the cryptocurrency question. I guess most people probably do, their returns on TurboTax Now forms, but it's a signal of the importance to the IRS. And so you say, okay, well, how do we disentangle this from the general increase in reporting? And the way that we kind of thought about it was like, okay, well, who is the most likely, right? It's not going to be your customers, your clients, Pat. It's going to be people who don't have a paid preparer, right? Because if you have a tax preparer, right, they're going to ask you, right? They're going to know cryptocurrency is taxable, right? They're hopefully kind of helping you report or saying that you have to report. And so we look and say, okay, among people who self-prepared their return, they didn't have a paid preparer, do they increase, right? Does this question, now they have to actually answer, they have to think about it. Does it increase? And we do find an increase. I will say the magnitude is not huge, right? It's really small. And so it's not like, oh, we went up from, 20% reporting to 40% reporting, maybe a percentage point, probably less than that. And so we get a very small increase, but it does seem to have an effect.
Do you think the 1099 DA will have more of a substantial effect
I think definitely, just because that the IRS has it, right? You can lie on the checkbox. You can check no and just lie to the IRS. But if Coinbase sent something to the IRS, like you don't have control over whether or not the IRS gets that. And I definitely think the real test is going to be 2026 tax returns, right, that we file next year, where we say, okay, now the IRS has your basis. They know the actual amount of gain you have. We know from other areas of tax that, right, compliance with W-2 reporting, right, basically 100%. Everybody reports their wages. I expect to see very similar numbers of at least the stuff that is reported on 1099 DAs is going to be reported on tax returns. I'll be interested to hear your thoughts on this. Vic, people are I'm a little bit more interested in is, do people go into more DeFi? Are you seeing clients, right? Well, maybe not your clients, because obviously they're reporting their taxes. That's why they're coming to you. But, right, do we see individuals who are like, hey, Coinbase is going to report, I'm going to go, just do my trading on Uniswap, or I'm going to go and just like take the kind of foreign risk and go get a VPN and trade on a foreign exchange where we know KYC happens, but maybe isn't, 100%. And so you can probably get away with trading on those other exchanges in foreign countries where you don't have this reporting. And so do we see volume just kind of move to those areas where there isn't reporting?
Yeah, I think it's going to be really interesting to see that. And I can't say I've seen that behavior in my clients, which I agree, like probably isn't the best subset for analyzing that. But what I have seen just in conversations just with other practitioners and taxpayers and just, even like conversations out in social media is that idea has definitely been interjected into the conversation where, you can go and do your transactions decentralized and just, if necessary, port stables back into the broker, which I can't argue would simplify reporting, but if that's the only thing you're doing it for, but it obviously can lead to no visibility into those transactions and a lower compliance rate, which the whole form was designed to fix. So it's going to be interesting to see how widespread that is. I think over the next couple tax seasons. I agree with you there. And then this conversation about the DA and lack of compliance brings up another interesting topic, which is prediction markets that are generating more and more volume, more and more users, taxable activity at a greater scale than we've seen in the past. And there's limited NDA reporting that I've seen from these platforms this past tax season, with even platforms like Kalshi not issuing comprehensive 1099 DAs for all of the event contract activity. Tons of questions around the tax characterization of the event contracts themselves and divergent tax positions across taxpayers and even practitioners. So I think there's a lot of parallels between these two markets, and it's a whole nother sort of subset of this financial frontier that's forming where there isn't any tax reporting. So has that been on your radar at all? And what is your outlook there? Do you think we're going to see more? Is this going to be like the same, history rhymes, kind of like we saw just with the general crypto compliance? Just like, what's your overall thoughts on that?
Yeah, it's super interesting. And I think I've seen some of your posts on it, right? How do we report these? Because I don't think we have good answers. Are they truly commodities? I'm a little bit on the fence about that. I think from a political standpoint, we need clarity, and that, realistically, if something doesn't happen before November, right, we're probably not getting that for a while, which is going to be an issue. But there's a large amount of volume there. And with the new gambling rules that go into effect under the OBBA next year, right, it would not surprise me if an administration looks and says, hey, we need to raise some revenue. 90% of losses on prediction markets limited to gains as an itemized deduction is going to take a lot of those losses on prediction markets, right? Because you've seen the reporting that most people are losing, right? It's a tiny fraction of insiders that are actually winning on these markets, right? The government can potentially treat those as gambling losses. That's a huge amount of revenue, right? If you treat them as commodities or you treat them as crypto, right, then you're just limiting maybe to capital losses, right? But most people are losing money, so it's not a big revenue raiser. So it's really interesting. I think it's kind of this, what I would say, a little bit of a flipped situation. And tell me if you agree with this, because I think crypto in general, or some of the DeFi stuff is very unknown, but in general, like buys and sells, right, transfers, we know how they're taxed. Right? You might not like how they're taxed. You might not agree that it's property. You might wish it was some other way, but largely, like, if you give any accountant a list of buys and sells, figuring out the gain and loss is not that hard. Like, the tax treatment is not that hard. Figuring out the actual gain or loss is the hard part, right? It's like, okay, tracking the basis across all of these different transactions. Prediction markets, it's almost like flip. Like, we don't know how to report it, but it's really easy to tell you that I lost money or that I made money, right? Because every contract, it's you get $1 or you get nothing. You know what you put in. It's all settled in USD. you can't do contract swaps, at least not yet. And so like, it's just the super simple buys and sells. It's really easy to identify. All right, how much money did I make? How much money did I lose? But we don't know how to report it, right? We don't maybe know where exactly that's going to go on the tax return.
Yeah, I agree with you. I think it's like in the early stages of where crypto was, is kind of my perspective, almost like pre 2014-21, right? To where we're still not even sure the IRS's perspective on the basic tax characterization of these contracts, and to what degree you need to look at these contracts separately based off of the underlying nature of them and the type of events. So, I think that's maybe why like your comparison holds true, because after we got that notice, then we're able to have more of these like nuanced tax arguments, right? Like in the early days, do like kind of exchanges apply, and now we're to staking and wash sales application and all these types of questions. So I think all that's potentially to come with prediction markets, and probably like the first step is getting some sort of guidance, maybe a notice like we saw with crypto, where we get a basic characterization around how these contracts should be taxed, possibly also reporting requirements for them to be included in some form of a 1099-B or DA, depending on what's applicable for the platform. I think is probably the first step for this, and then from there I think there's a lot of downstream tax questions even from that. If some of these contracts are looked at as gambling, like you said, there's the loss limitations, there's the consideration around what constitutes a session if you're just continuously transacting in these throughout the year. There's different types of market participants that may be hedging and arbitraging, and it's a question of how is their activity looked at. So there's a lot of nuanced tax questions, and just like the early days of crypto, there's people that are pursuing more aggressive treatments like Section 1256, which it's not clear that these binary event contracts fit into the statutory definitions for 1256, which the closest one would probably be non-equity options, right? But due to the nature of these, it's not clear that it fits in there. So I think just getting that like characterization, and that's how early days I think this is, the characterization and the reporting, and then we'll probably have all these more detailed issues from there. We'll have to say.
No, I'm very interested. One thing you didn't mention is state treatment too. Because states are clearly saying that it's gambling, right? Because that gives them the power. And, if you have to say, hey, we're going to do it, as a capital gain for federal, but now we're going to do state, and state follows the federal rules for gambling, and now you're limited to 90% anyway. Like, in a state like California, New York, Illinois, these states that are, I don't know I don't know if there are any Republican states that are suing, right, to treat it as gambling, but it could be a potentially.
The states have the whole excise tax issue too. Is the whole other issue, because if it's not under the gambling regs, then they're not able to charge the gambling excise tax, which is can be substantial depending on the state. We've even seen some states start to float proposals for similar taxes just on prediction markets, which I think is also pretty interesting. So I think it's just very, very early days for all this. And I was interested to see if it's on your radar, because I think the compliance issues are similar, and there's definitely an overlap, obviously, between this and crypto, which some of these platforms utilize stable coins. So I'm very interested to see how this unfolds here in the future. Tyler, do you have any other, to put a cap on this, any other future research projects that you want to put on people's radar, number one? And then number two, based off of this, what is kind of like your top priority that you would want to see, either from a compliance design standpoint or a policy standpoint, that you think can help increase the compliance rate, if you think there's anything that can be done that's top of mind?
Yeah, I mean, I think, from my perspective, I am very interested to see where the 1099 DAs go. I'm interested to see, again, my other research, just how cryptocurrency tax reporting evolves, both from the third-party reporting side, from the individual side, from these crypto service provider side, because I think we have not solved it at all. If I had to make my pitch for policy, I think, my top two that I will always advocate for: Congress just pass a freaking mark-to-market election. for cryptocurrency. Like, let us pay the gains at short-term rates and ignore all the reporting, right? Because it would make so much easier. And then staking, I have another policy piece with the Tax Policy Network, going over my view on how staking should be taxed and kind of conceptually. I think we do need some just firm guidance on there because there's such differing opinions between tax professionals on how it should be and how it even is right now taxed. So I would really like to see kind of that guidance come out, get some clarity just on, some of these questions that are still open. No, I don't know if you saw, House released their draft of the Clarity Act, which I did not see anything tax related in there besides a few mentions to kind of some of the criminal enforcement stuff with the IRS. But it doesn't seem like we're getting a crypto tax bill anytime soon unless we add something onto that. So I'll kind of keep an eye out for there, but yeah, that's kind of what I'm looking forward to or thinking about.
Yeah, I agree with you. Just getting the clear guidance on staking, because like you said, there's many different opinions, which leads to divergent tax treatment. And then you have taxpayers that are similarly situated and they're just getting treated differently for tax purposes. So just getting that guidance, getting even treatment for everyone that's clear, and making sure everyone's calculated basis stays clean as these staking transactions go into it can go a long way. I don't disagree with you there. So Tyler, this conversation has been great. I'm really glad we had the opportunity to have a substantive discussion around the work you did in this research paper and some of your findings. We're going to link to the paper, but if you want to briefly just, let listeners know, like, where's the best place if they wanted to independently find the paper and overall just get in contact with you and find more of your research.
Yeah. So if you probably just search for me, my website should come up. I think my name is unique enough that we've got the SEO down. So I have a website. I have my papers there. But this paper in particular, it's published at the Review of Accounting Studies. If you just search for Review of Accounting Studies, you can find it there. We are lucky enough that through one of my co-authors, it's open access. So you don't have to pay that crazy $20 or $30 to download a copy. Like, it is free for everybody. You can go download it. I think it's fairly approachable. Kind of a lay reader and some interesting stuff there, even if you don't, necessarily know all the statistics. And if anybody wants to reach out, search me. My email address at TCU here is public. You can definitely reach out through my website, and I'm, always happy to talk, as you've probably seen.
Well, I encourage everyone to read the study because, we did cover a lot of ground here, but there are a lot of details in the paper that we weren't able to cover. So definitely take a look at it. It is eye-opening and very interesting to go through. So Tyler, I really appreciate you being a guest, and I'm sure we'll have you back on here shortly for another interesting discussion. To everybody that watched, again, I do encourage you to go read the research paper, but I do hope that you took some value from this conversation here today. Until next time, I'm Patrick Camuso signing off, and I do want to thank Tyler again for coming on as a guest.
Thank you. Have a good day.